Tell me the truth. Have you ever been in a situation just like this where you are looking at a consolidation and you want to trade the breakout of the range and you've drawn your resistance area and you're just absolutely just chilling and vibing, and you're looking at the price action continue and you're just simply waiting for the price action to break out. And then when you do see the price action break out, this is a very bullish candle and you get FOMO and you don't want to miss out because you see that the price action can go a lot higher. So let's say you go ahead and enter your buy. And let's say you put your take profit at the next support resistance area right over here. And of course, like any normal confident trader, you move your stop loss right below the actual zone. And then as the trade continues, you are just absolutely vibing, and then it goes absolutely against you. If you've ever been caught in what's called a false breakout, this video is directed to you. Today, we're going to alleviate all your pain. I'm going to teach you exactly how you can avoid situations like these and what you can do to increase the chances of you entering proper trades on these breakouts and avoiding false breaks such as these, and save yourself some time, energy, and money. So if that sounds interesting to you, then go ahead and subscribe to this channel if you haven't already. And for those of you that are subscribed, welcome back, and make sure you hit the notification bell so you don't miss out on any future videos and trainings that we release on our YouTube channel completely for free. So first things first, let's understand the psychology behind why people even enter trades just like these. When they see the price is consolidating during a range and they see a very bullish candle break out, they don't want the train to leave them at the station, and they get a sense of FOMO. They see the price creating a parabolic move to the upside or downside, and they don't want to get left behind. And they enter the trades just based off of momentum, and they don't really put any additional technical indicators, technical factors, or fundamental analysis into this. They just do a quick, blind, rough, dirty trade. And that's how newbies get stopped out. So we want to avoid things like these. We want to take additional precautions to make sure the probability of the trades that we enter are a lot higher. Now, I do want to let you know that it is impossible to avoid 100% of the false break. So just know, no matter what you learn, you will always encounter some situations where the price breaks up and you do everything right and the price still goes against you. That is inevitable. That is just a part of trading, and that is normal. That is a fact that we all must learn to accept before we can continue on our trading journeys. Now that we understand that, I want to talk about, so let's say you wanted to enter on this parabolic move over here. You saw this and you didn't want to miss out on the price of gold increasing any further. So let's say you want to enter a buy right over here. What's going to happen is if you enter a buy, we need to logically figure out where should we put our stop loss based on technicals. So if you want to enter a buy, the real only logical place that we can possibly put our stop loss would be at this next zone over here. So if you wanted to enter a move like this, there's no other technical factors in the past that we see here that we can use to put our stop loss. So if that was the case, a stop loss has to be extremely deep, and this just doesn't give us a good risk management system. However, contrasting that, if we got into a situation where we have a non-parabolic move and the price action is moving like this, and if we wanted to enter a buy, well, guess what? We entered our buy here, and our stop loss would be at the previous zone right over here. This still gives us a lot better risk to reward ratio instead of waiting for a massive parabolic move towards the upside. So if and whenever you do see a parabolic move like this, don't get FOMO and rush to enter just because the price has already moved up. By then, it's already too late. Now let's do another example of what to avoid. So right now we are on EuroCAD on the 4-hour chart. So if you do see like a range consolidating, and even if it isn't like a parabolic move to the upside or the downside, and if it's just a normal breakout, notice these previous candles were simply just kind of wicking past the support area, meaning the price action stayed within the actual zone. And now this is the actual first time where the price action has pierced through and then closed below the zone. This might give people a signal to enter a sell because they don't want to miss out on this momentum. And then if you want to enter a sell here, let's say you entered a short position, and obviously you have your stop loss within the range, This would still not be an ideal way to trade simply because of the inherent nature of chasing the trade. Because we saw all these candles go down and they're all red candles, we want to enter on the sell, we want to enter a short. By this point, our stop loss has to be so far in order for this trade to be completely invalidated, which completely ruins our risk to reward ratio. So you don't want to enter any trade just simply on the break, looking at just candles breaking through the zone. We want to think a little bit deeper. So let's go into that. There's a lot higher chance, a lot higher probability of an actual proper breakout occurring during moments, during situations where the price is squeezing, where the price doesn't have a lot of volatility, where the price isn't fluctuating a lot, where you see the price is tightening. At that point, that is at a moment where there's a high probability, more often than not, that the price will explode either up or explode down. And it is at that moment where you want to be able to look for areas to enter your buy or sell for the breakout. So let's do an example. So right now we are on Euro NZD and we see the price is creating some type of support right here in this area. And we can see from the top side, what the price is actually doing, it's creating lower highs, meaning the highs are getting lower and lower and lower. This high, this high, this high. So what we can do is we can draw a trend line starting from the top of the wicks and then extending that all the way down. And then what we can potentially see is the price squeezing in between these two bounds. Now the price can break out either direction, either towards the top or either towards the bottom. But let's talk about probabilities. So what's actually happening here? There's a lot of selling pressure to the downside. And then as the buying pressure kicks in, each following impulsive move, the buyers are in less and less of control. As the sellers continue to push it back down, what happens the next time that the price action goes up? The buyers aren't able to push it high enough as the last time and as the last time. So is a buyer's strength weakening or is their strength strengthening? If the buyers aren't able to push it as high as the previous times, that means they're losing steam. So even though the support zone is being held strong, the highs are getting lower and lower and lower. So one way we can enter, the smart way to enter on these type of breakouts is to enter somewhere on the squeeze. This way you're able to have a tighter stop loss so you can enjoy the pips of the actual breakout. Let me kind of show you what I'm talking about. So as the price approaches this trend line, this would be an area where we would want to enter a sell. Why? Because it is being squeezed and the tops are getting smaller and smaller and smaller. So what you can do is you can enter your sell position and your stop loss, you can put it above the previous high. Depending on your aggressiveness, this could be considered your previous high. So you can put it above that. Or if you were a little bit more conservative, you can put it above this last high over here, which is around 65 pips, which is pretty decent. So now that you have your trade set up, why? Because the highs are getting lower and lower and the price is indeed squeezing. Now you have a lot better setup, a lot better entry compared to if you entered after the breakout. This is going to give you a lot worse entry because your stop loss would have to be up here and your take profit would be wherever you had it. So instead of entering down here, there's a wiser entry to enter up here. Why? Because you get a lot better risk to reward ratio. Now let's do another example. Let's say you're in a situation where you see the price is squeezing and you want to draw your technicals. So let's say you draw your zone right here. The price is squeezing to the top side. And let's say you see the price is creating some higher lows. So you also put in your trend line right there as well. So, all right, guys. So you tell me, where would be the best place to enter on this trade? First and foremost, would we want to enter a buy or would we want to enter a sell? Is it a higher probability that the price action is going to break this way? Or is it a higher probability that the price action is going to break this way? What's happening with the price action? The price, the lows are getting higher. The lows are getting higher and higher and higher, meaning the selling pressure is weakening. Every time the sellers get their turn, it's weakening each time, and the buyers are able to push it back up to this specific resistance point right over here. So the ideal direction to enter your trade would be a buy, would be to enter a long, but the question is, where would we enter? Would we want to enter here or here or here? what's the best place to enter? The answer is the ideal place to give us the best risk to reward ratio is to enter on this trend line for the buy, because if it does break out, it's higher probability it's going to break out on the top side. And if it does break out on the top side, we want to have a better risk to reward ratio rather than entering somewhere up here. So let's go ahead and continue. So this would be the place where we would want to enter our trade for the buy. So we set our long position here. We want to make sure that our stop loss is below the last low, which is around this area right over here. And we could put our take profit around this previous high over here. And then we are off to the races. Now, I want to take a moment to pause and discuss. This was that parabolic move I was talking about where the newbie traders would enter. If a newbie trader saw the price pushing with momentum to the top side, this is where newbie traders would enter, and they would want to enter their buy, getting a not really ideal position. And then where would their stop loss be? Their stop loss in this case would be most likely below the zone. If you want to be more conservative, you would have your stop loss below this squeeze area, this ascending triangle. But for most people, it would be okay to put their stop loss below this zone right over here. But you'll notice the risk to reward ratio from this one was around 5 risk to reward ratio for this first trade. But for the second trade, the risk to reward ratio for the same take profit is only 1. So if you're going to risk $1,000, you're only going to make $1,000 on this trade. In this case, if you were going to risk $1,000, you're looking to make $5,000 or $4,980 more specifically on this trade, about $5,000 on the upside, $1,000 on the downside. And this is a 1-to-1 risk to reward ratio. So this would be the worst place to enter your buy. But now let's talk about, let's say you didn't spot this ascending triangle quick enough. Maybe too many things were going on in your life and you didn't really spot this until the price broke out. There still is a chance you can enter your trade to capture the move of the breakout, but this would not be the ideal place. Let me kind of explain and teach you where the best place to enter this buy position would be if you missed this initial trade down here. This is A, this is trade B. Now we need to figure out where trade C would be if we missed trade A, because we know we're not going to enter on trade B. That's the worst place to enter. So instead, how we would enter a trade like this is we would want to wait. We need to be patient. Need to be patient and wait to see if the price retraces back down to this same support and resistance area, the same zone of interest. And if it does reach this area, this would be the ideal place to enter our buy had we missed trade A. So if it does approach here, that is our entry. If it doesn't approach it, then we just move on and find the next trade. So in this case, we'll go ahead and put what's called a buy limit. We want to enter a potential buy for if and when the price approaches this area. And just to clean things up, let me go ahead and delete these previous trades. We want to enter a buy limit, a pending buy, in case the price touches this area, and then we'll be in the long. So that activated our trade, and now we are in our buy position. Same concept, our take profit is at this zone over here, and then our stop loss would be below the zone. So in this case, we have roughly the same risk to reward ratio as this bottom trade. We have a 4.7 risk to reward ratio because our stop loss is just below the zone, whereas this stop loss was below the last low, and our take profit is in the same area. So this gives you a very similar risk to reward ratio as this trade. You're capturing less pips. So this would be the most ideal entry. This would be the worst entry. And this would be the second ideal entry if you wanted to trade the breakout. Now, I want to do another example just to show you that things aren't always all sunshine and rainbows. Currently, we are on Euro USD on the 1-hour chart. Same type of concept, same setup. And we want to do the same thing, right? So the first things first, we want to try to enter on this trend line. And if it does, that would be our buy. And in this case, it looks like the price did actually already break out. The price closed above the zone and the price didn't hit our entry. So in this case, our buy was missed. The train left without us. The buy should have been down here, somewhere on these wicks over here. But in this case, we missed it and the price actually broke out. So now what are we doing? The same exact concept. We're waiting for the break and retest. And as you can see, the price never came back to retest this area. So in this case, we were left high and dry with our hands in our pockets. And the reason I wanted to show this example is just to illustrate the fact that things aren't always perfect, right? So even if you have the best setup and you want to wait for the perfect break and retest, it's not always going to happen. The price can often leave without us, but that is completely okay. This is a numbers game. We are trading based on odds. So if the price doesn't come back, it's fine. We move on and we find another setup. One thing you don't want to do is chase the trades, because that can get you in a lot of trouble and you'll have a stop loss a lot wider than you initially wanted. So if you miss a trade like this, no big deal, just move on to the next trade. Now, as I mentioned earlier, a time where a breakout is inevitable to occur is at a time where the volatility is being squeezed, where the price action isn't moving up and down as much, where the candles are getting smaller and smaller and smaller, and the range of the candles is shortening. So these type of situations, if you were someone who uses indicators, another way to kind of look at this is you can pull up the ATR, the average true range indicator. This essentially shows you the volatility of the currency pair. The higher that this line is, that shows you that that pair during that period was a lot more volatile. If the line is towards the bottom, this shows you that the pair wasn't as volatile during that time. So for example, you can see the price action was creating a floor, and then the tops were getting lower and lower and lower, and then the volatility from up here was getting smaller and smaller and smaller. That shows a breakout was inevitable, and there these price started melting. Same exact concept over here. Compared to the most recent price action, this is at an area where the volatility is low, the range, the average true range is low. This shows the price is squeezing and the price isn't moving rapidly up and down as much compared to the past. And we also do see this descending triangle, which gives us a clear signal to enter a sell, ideally on the trend line right over here. And let me just kind of zoom in and let's see how many pips this would have given us on this trade. Around 1,000 pips on this trade, waiting for the squeeze to break out and entering not after the break, entering prior to the break, so we can capitalize on the entire move. And you can see the average true range absolutely shot up compared to the low that it had over here. Now, I'll do a few more examples to wrap everything up to make sure you genuinely, truly do understand how to do this the right way. And before I do, guys, if you find this information valuable and it is useful, please drop a like. It really helps this channel grow. And subscribe to the channel if you haven't subscribed yet, and share this video with other traders that are just like you, brand new, that are looking to become profitable. That being said, let's go ahead and talk about this example. We are currently on EuroCAD. So what we're looking at here, we're taking a lot of things into consideration. First things first, we are looking at the overall trend. The overall trend is a downtrend. The market is trending downwards overall. So it is a higher probability that the price action is going to continue in a continuation pattern rather than pulling a U-turn and reversing going the other way. So if we wanted to enter a trade, just based off of just simple probabilities, is a wiser decision to enter a sell, to enter a short. So the first option would have been entering on this zone. But in case we missed it, the next option, as I've described and mentioned, would be not to enter on the break, but to rather be a little bit patient and wait for the potential retest to get a better risk to reward ratio. And by the way, guys, if you can't really tell the trend, depending on the time frame that you're in, let's say we're in the 1 hour chart and you can't really tell which direction it is, always feel free to go up a time frame. I'm going to the 4 hour chart, and you kind of see that it is definitely descending. The price action is going down. Let's go ahead and go back to the 1 hour time frame and let this play out. So the price action definitely closed and pierced below the zone. So this is a clear break. This is where we definitely do not want to enter. We want to wait for the possible retest so we can enter our sell. So what we can do at this point, we can kind of prepare and put our sell limit. We can put a sell limit somewhere in the zone. We want to make sure that our stop loss is above the zone, and then we have our take profit wherever we want to put the take profit. This gives us a lot better risk to reward ratio, and then a TP hit. Here's another example, guys. We are on GBP AUD and we have a resistance area right here. So in this case, let's say the price action is bullish. We want to enter a buy on the breakout of this resistance. So let me kind of show you the difference between entering on just the break or waiting for the retest. Okay, so this price action shows that the price definitely broke out. So if we wanted to enter our buy here, our stop loss would have to be the only logical area, which would be below the zone, below this area. So in this case, where is our stop loss? How many pips is our stop loss? Our stop loss is 142 pips in this scenario. This is a massive, massive, massive stop loss. So you definitely don't want to have a stop loss this wide. So this is why this is not the ideal to enter your long position in this area. But instead, if we wanted to enter on the breakout of here, it is a wiser decision to enter on the retest. So right over here. So in this scenario, what happens? What's the point of a stop loss? The point of a stop loss is to cut our losses in case we are wrong. Because remember, guys, trading is a game of probability. We can be right, we can be wrong, but we always want to be thinking about the downside. In the off chance that we are wrong, we want to minimize our losses. So in this case, this is a better entry than over here, which our stop loss was over 150 pips. And in this case, our stop loss is around 50 pips or so. Then we continue. And then if the trade did hit our stop loss in this case, then we've lost 50 pips, one trade. It isn't the end of the world, but our risk to reward ratio would have given us a 3.73 risk to reward ratio. And I'm intentionally giving you examples of winning trades and losing trades, so you at least know how to manage your trades in situations where you win the trade and in situations where you lose the trade. You guys need to be aware of what occurs on both ends of the spectrum. Now that was the daily time frame, and I'll give you one last example. That was the daily chart. Let's use the same exact chart, but let's now go to the 1 hour time frame and let's look at this same concept. If we were entering a trade on the same exact breakout of this resistance, what do we see here? We see a clear break, and then as the price dipped down to retest it, this would have been a winner trade if we were on the 1 hour chart. Guys, it matters what time frame that you're looking at, because you can see a completely different picture if you're on the 1 hour chart or the daily chart or the 4 hour chart. So if you were entering a trade on the 1 hour chart, guess what? This would have been a perfect entry for the same concept, for the break and retest. Our stop loss is below the zone, and then our take profit is wherever. In this case, the price went up from our entry to around 150 pips take profit right over here. And the reason I share this example is because I do not want you guys to get blindsided or have your blinders on. Always make sure that you're nimble and fluid, and make sure you're looking at other various different time frames. It's because the same concept works at every different time frame, but you just have to be aware of what time frame you're looking at. And because trading is a game of probability, sure, this trade ended up working out because we used technical analysis, we waited, we did the right thing, but this next trade on the daily time frame didn't end up working out. Again, it's all about probabilities, and you have to be okay with losing and you have to be okay with winning. That being said, guys, hope this was valuable to you. If you have any questions, feel free to drop your questions in the comment section below. I'll be more than happy to answer any of your questions. Or if you just want to drop down and hang out in the comment section, say hi to me, that would be fine as well. That being said, I hope you enjoyed this video. Catch you guys in the next one. Take care.